Today, I'm sharing the top 6 mistakes that I wish I knew when I first started investing in crypto. There are tons of dangerous traps for beginners, but once you know them, they're easy to avoid. So if you want to be a smarter crypto investor, keep watching. Welcome back to the Virtual Bacon channel where I teach you how to build wealth in crypto. The truth is, crypto can be complex and has left many newer investors holding worthless tokens. In crypto, we call this holding the bag. These are the top 6 things I wish I knew when I first started investing in crypto. If you want to stop being a bag holder, then pay attention and let's get started. To be a good crypto investor, the first and most important rule is to avoid high leverage trading. When it comes to purchasing cryptocurrencies, there are two main ways: spot trading and leverage trading. Spot trading simply means you are buying the tokens on the spot with the money you have in your account. So if you have $1,000, you can buy $1,000 worth of crypto. If you've ever purchased a crypto or stock, it's likely through spot trading. On the other hand, leverage trading, also known as margin trading, lets you borrow money from an exchange to buy more crypto than you otherwise could. This is just like leverage trading in traditional finance. Leverage trading is more complex than spot trading and carries much more risk. Here's why. Assume I have $1,000 in my account and the price of Ethereum is $1,000. This way, with spot trading, I can buy 1 ETH. With leverage, I can use that $1,000 as collateral and take out a loan for $2,000. This gives me an additional 1,000 of buying power. Now I can buy 2 ETH instead of just 1. This means I hold twice as much ETH compared to spot trading. So if price goes up, I get twice the profits. The problem is, if the price collapses, I double my losses. See how that can get risky during volatility? To put it bluntly, leverage trading is designed to take advantage of the average investor. One complexity is your P&L, or profit and loss, which is a live number that shows how much money you have made or lost at any given instant. This is a design exclusive to leverage trading, since you technically are not holding the coin itself, but rather a trade position. This is what people refer to as a long or short position. The problem with this is the P&L number will fluctuate much more dramatically than a regular investment position. That's because your exposure is amplified by the extra leverage. On top of this, leverage also carries the risk of liquidations. Liquidations, also known as margin calls, happen when the collateral you put up for the loan is taken away by the exchange. The exchange will do this to make sure they can recoup their money if your leverage trade is in a big loss. Liquidations are triggered at a predetermined price and will vary based on how much leverage you use. Once your liquidation threshold has been reached, your money is gone for good, even if the token price reverses just seconds later. Take the $1,000 ETH example again. If I only use $1,000 to buy $2,000 worth of ETH with leverage, I will be at a 2x leverage. When this trade drops by 50%, I will lose all my money. This still seems acceptable because 50% is a big margin. However, if I do a 3x leverage, I will lose all my money when the trade drops 33%. 4x leverage, 25%, 5x, 20%, and 10x leverage, you only need a 10% drop to lose all your money. You see how the risk of going bankrupt quickly increases. This risk doesn't exist with spot trading because you can buy and hold a token for as long as you want, even if the trade does poorly. Personally, I have only used a maximum of 3x leverage. Anything above that, I think you are bound to get wrecked eventually. Okay, so if you take anything away from this part of the video, it's this. While spot trading won't be as profitable on an individual basis versus leverage trading, spot trading is much safer and profitable over the long term. If you don't believe me, look at some of the largest crypto hedge funds like 3AC or Alameda. These funds were created by some of the most successful traders in crypto history and had access to the highest level of data possible. While several factors led to their collapse, high leverage is what started the chain reaction. No offense, but you aren't a better trader than these institutions, and neither am I. If you keep trading with high leverage, you will eventually get burnt. The next mistake is falling in love with your coins. Don't do it. In crypto, it's easy to fall in love with an investment narrative. We've all seen this trend with things like DeFi, GameFi, Metaverse, Layer 1s, etc. Look, I get it. It's hard not to buy in when sectors are shooting to the moon overnight and early investors are getting rich. But you must first consider why you are buying. Is it because your coin is part of a narrative, or is it because because of fundamental value. If it's because of the narrative, you need to be prepared to take profits early, as the price is guaranteed to come back down to reality. The problem with narrative investing is that old narratives fall by the wayside as time moves on. Ask yourself the hard truth. If the token collapsed 50% right now, would I still believe in the project? Do I even have a plan for when this happens? Or am I just here because of the hype train? Don't get me wrong, narratives are important as they ultimately drive the crypto market. Understanding the newest narratives and knowing where your investment thesis stands is crucial to being a good crypto investor. But you need to clearly identify whether you're investing based on narrative or on fundamental value. Buying gaming coins or metaverse coins when they are hot is not fundamental value investing. Fundamentals are things like valuations, how the project compares with others, how the team is delivering on their product, and token revenue share. You should only hold on to a project long term if you have these metrics and can formulate a concrete plan. This also involves clear take profit targets, stop loss in case you are wrong, time frame of the investment, and how much risk you are taking on. I'll be making a full video on creating investment plans, so make sure to subscribe and stay on the lookout for that. I know it's difficult to take profits when everyone is euphoric and shouting up only, but this is the key to survive long term in the fast-paced world of crypto investing. The next mistake that is too common is trying to catch the bottom or the top. I'm not a psychic, you're not a psychic, so stop trying to be one. In theory, everyone would buy low and sell high, but in practice, in order for you to time the bottom or the top, you need to be able to trade against the herd. This isn't practical or sustainable for long-term success because you're bound to be wrong. By definition, euphoric tops happen when everyone thinks the market can only go up, and capitulation bottoms happen when everyone gives up and thinks the market is dead. The keyword everyone includes you and me, and these periods of peak euphoria and depression are the most difficult periods to go against the trend. We are not special, so stop thinking that you are the odd 1% that will happen to do the opposite of everyone else. The best traders don't try to time the bottom, but rather have different methods of dollar cost averaging or DCA. Most people think DCA is only a boring passive strategy that lets you invest periodically. However, dollar cost averaging is also extremely useful in active investing. For example, if you think the Bitcoin bottom will be within the next 6 months, you can allocate a budget that will be spread out over this period of time. This guarantees that you will be able to buy at an average price similar to the bottom price. And you don't have to stress about finding the perfect entry or risk potentially missing out. Let's face it, you can do as much technical analysis as you want, but it won't guarantee any success. When charts break down during volatility, traders start to panic as things aren't going to plan. Dollar cost averaging is the best way to take emotions out of trading and guarantees that you have a good enough entry. Over the long run, this is much more profitable than trying to time the bottoms and tops. If you want to learn more about my buying strategy and how I handle bear markets, check out my Bitcoin bottom strategy video, link is in the description. The next two mistakes are around DeFi and passive income. First, you need to understand the difference between good and bad yield. In crypto, people love making passive income through yield, also known as interest. This is an incentive for you to lend out your assets for better or for worse. The Luna crash is a prime example of how high yields prove to do more harm than good, and why you need to know where yield comes from. In crypto, yield comes from either an inflationary token or through real revenue, or more commonly known as real yield. With an inflationary token, this method is more aligned with a Ponzi scheme or having Ponzi-nomics. This is because the rewards are printed out of thin air and strictly rely on other people buying the token. Depending on certain token models, inflationary tokens will get paid to those who stake on the network or provide liquidity. These incentives are often set at a predetermined inflation rate. The catch-22 is that the higher the APRs, the faster it dilutes the token supply, and thus the faster its price goes down. As we saw with DeFi Summer, high APRs were unsustainable and token prices eventually all tanked. This is due to people cashing out the rewards, which puts sell pressure on the token. Think of the infamous Olympus DAO, where yields were as high as 40,000% per year. The Ohm token peaked at $1,200 and now sits at under $10. I was personally burnt by this. Even with the super high amount of new tokens I got, I was still at a huge loss. So far, Curve Finance is the only inflationary token farm design that has survived for over 2 years, and its farmers actually made a profit. If you're yield farming a token and the price crashes, you are almost guaranteed to lose money, regardless of how much rewards you earned. So the alternative to inflationary yield is real yield. Real yield is when the interest earned comes from the fees that are generated by the project's users. This is without a doubt my preferred way of earning yield. Real yield is a great way to avoid diluting token supply and reward those that are providing liquidity. I've highlighted these in my latest crypto passive income video where you can get 30% APR on Uniswap v3 and GMX exchange simply from their trading fees. Both of these are real yield strategies. If you want to check it out, link is in the description. On top of this, you can clearly see where the yield comes from. We have a common saying in the crypto space: if you can't identify where your yield is coming from, you are the yield. Moving on to the next mistake people tend to make when farming in DeFi is too many people lock up their tokens for rewards. Locking your tokens is just another unsustainable attempt to generate yield and incentivize people to buy the token. Locking tokens is appealing because they are usually offered in tandem with high yields and promises long-term growth potential. The longer you lock your tokens, the higher yield you can get. For someone who plans to hold a token long term, it may seem like a no-brainer to lock your tokens and earn interest. But here's why you should be careful with this. Token locking is designed to decrease the circulating token supply, as well as reducing the number of coins that can be sold. This pumps up the token price in the short term. The problem is the tokens will eventually unlock, and you face the same problem again of everyone selling the rewards while they still can. Not only this, but many projects see token locking as a way for the teams to easily dump their unlocked tokens while retail investors stay locked. At the end of the day, what really matters is whether the protocol generates revenue. If projects lock both the team and the retail investor tokens transparently and lets everyone accrue revenue slowly, this is okay and aligns with the project's growth. However, if the project lacks merit, token locks can be a big trap. Also, as I mentioned earlier, having high APRs can be beneficial for a period of time, but if you can't sell a token, you are screwed if the price eventually crashes. Crypto markets are volatile, so I usually avoid locking tokens as it's a risky game with minimal benefit or supporting evidence of success. And this brings me to the last mistake I see beginner investors make, which is investing in something they don't understand. If you want to be a successful crypto investor, or any investor for that matter, you need to have deep understanding of where your edge is and what your advantage is. While crypto is a catch-all term, it's really a fragmented industry with many sectors and methods to make money. Things like DeFi, NFTs, gaming, Layer 1s and Layer 2s, new project ICOs, swing trading based on catalyst events, so on and so forth. With all the different sectors, protocols, and token structures, it's impossible to be an expert for the entire crypto space. To be a smart investor, you should start by conquering one sector first. If you're able to master just one thing, you'll be able to find awesome investment opportunities. This could mean something like becoming a DeFi master and knowing where the best decentralized exchanges and yield opportunities are. Or an airdrop hunter that knows how to find and qualify for the biggest airdrops like ENS, Optimism, or Arbitrum. These strategies can all be very rewarding, but will require dedication to understand the sectors deeply. If you find a niche to focus on, you'll start to beat everyone else when good opportunities are presenting themselves. This allows you to actually take advantage of opportunities early, instead of always juggling many sectors and always being late. Take the time to identify what your investment plan is for each opportunity. Otherwise, you are essentially just gambling. Okay, so if you made it to the end of the video, congrats. You now know the 6 most common mistakes that gets beginner crypto investors wrecked. If you can avoid making these mistakes, you're on your way to making a lot more money. I know staying on top of the crypto markets is tough, so to make it easier, join over 8,000 people and subscribe to my free newsletter on virtualbacon.com. Every week, I cover market updates, important events and narratives, as well as my personal investing insights. Remember to subscribe and like the video if you enjoyed this content. Thanks for watching, and I'll see you in the next one.